All right, welcome to Community CPA's Saturday webinar. Uh, Ordinarily, it's our CEO, Ingersoll Ave, giving our Saturday webinar, but I'll be the substitute speaker today. I'll be talking about SETC, Self-Employed Individuals Tax Credit. Right, so our CEO is very busy, super busy right now with the tax filing because September 15 is a due date, so which I might mention might be relevant to what we're talking about today. Okay, so but anyway, she's super busy, so I'll be doing the webinar today. So first, a few words about our firm. So Community CPA, so you can find us on our website, communitycpa.com. And so then, in particular, you can find announcement for our webinars, so including one for today, and then and of course the future ones, and also for our prior YouTube channel for our prior webinars. So you can find us on our YouTube channel, so which I will show a little later. But anyway, let's get started. All right, as I mentioned, so we're going to talk about SETC, so that's a tax credit for self-employed individuals. So I'll explain in more details about what that is. Okay, so basically it's, it's related to the self-employed individuals. Right, myself, Steve Howe, I'm a PhD and a professor at the university previously, so I'm retired now. I'm working at Community CPA right now. And so I'll be giving the talk today. So as I mentioned earlier, so Community CPA, that's our firm name, and then we have been in practice for over 26 years. And our staff collectively, we speak more than 10 different languages, and then we have more than 12,000 clients in our database from worldwide. And we currently have 5 branches. 2 in Iowa, Des Moines and Iowa City, and 1 in Minnesota, Minneapolis, and then 1 in California, Capitola, and also actually there's typo, so there's a Houston, Texas office as well, so which is in a soft open stage. Right, so our CEO served on NTA, so National Taxpayer Advocate panel, so a lot of taxpayer practitioners that know about that organization. So basically that's a advisory panel to the IRS. And also that panel helps taxpayers to resolve their issues or whatever difficulty they're encountering with in their dealing with the IRS. All right, so our CEO, as I mentioned earlier, Ingersoll, so she's the regular speaker for our Saturday webinar. And then, so I want to take a half minute or so to mention that she's written 2 books already, and it's a series of 4 books from 8 a.m., 10 a.m., then to 2 p.m. and 6 p.m., representing a business cycle, starting from the morning, and then you develop and then grow, and then sunset or retire. Okay, although she's already talking about she may never be able to finish the 6 p.m. because she may never retire. Okay, but anyway, so let's move on. So a quick no responsibility disclaimer. So basically, if you just listen to our webinar, and if there are anything that applies to you and you want to do it on your own, and you're doing it at your own risk, okay? So because just by listening to us, that does not form a client service provider relationship. So we are not responsible if you suffer, make any mistakes or suffer any damages as a result of doing that on your own. Okay, so and of course you are welcome to become our client so that we can help you to do the best we can, so to make sure that everything is done properly. All right, so coming back to the main topic of the day, so that's SETC. So that's SE, that's self-employed, okay, TC, that's tax credit, okay, so that's what SETC is. And that's not the official name. And in fact, in a moment I'll mention that IRS really doesn't like that name, doesn't like that abbreviation. Okay, so unlike ERC, which a lot of you have heard of and applied for, and many of you have even gotten that already. So the ERC, that's a standard abbreviation. Even IRS is using that, but this SETC, IRS is not using it, but it is used by a lot of people. Just it's so easy to, it's just simple abbreviation. So again, SE is self-employed and TC is tax credit. It's as easy as that. Okay, so what that SETC really refers to is actually two tax credits. Okay, sick leave tax credit and family leave tax credit for self-employed individuals. Okay, so there are tax credit for other individuals, but this one is specific for self-employed individuals. And then these two tax credits are authorized. They are related to COVID. This is still a COVID tax credit. Okay, so they were authorized initially under the FFCRA. That's the Family First the Coronavirus Response Act. So FFCRA, that was initially enacted in April 2020, but then I think in December of 2020 it was amended. Okay, so by the CAA, so-called, I think the Consolidated Appropriations Act. That's December of 2020. So basically that FSCRA was expanded through March 31st of 2021. Okay, and then it also loosened up some of the requirements. So that's the FFCRA. That's for the period from April 1st through April 1st, 2020 through March 31st of 21. And then in 2020, early 2021, the Congress passed another law, ARP, American Rescue Plan Act. So that act, that law authorized the same tax credit for an additional period. Okay, this is separate, not just expanding the first period. It's actually give you a second period. In other words, you can claim additional SETC in the second period, even if you claimed you were eligible and claimed for the SETC in the first period. Okay. All right. So second period is from April 1st, 2021 through September 30th of 2021. And for those of you who are familiar with the ERC period, so you'll see that basically that's the same ending date for ERC, right? So for unless you're a so-called startup business, so generally speaking, the ERC an employer's ERC claim period ends September 30th, 2021. So is this SETC. Okay, so you have two periods. Okay, again, so from April 1st, 2020 through March 31st, 21, and then the second period from April 1st, 21 through September 30th, 21. Okay, so the 2020 part, because the first period staggers between 2 years, year 2020 and year 2021. So the year 2020, which I will mention in a moment, that is less relevant anymore because the deadline for that has passed. But for period one, you can still claim that credit using the period, using the date from January 1st, 21 through March 31st of 21. All right. And so that's the law. Okay, so a law on your SETC. So that's a credit enacted by a few different laws. So IRS published several guidance to implement the law, and so in particular, there's IRS fact sheet 2022-16, and also IRS fact sheet 2022-15. Okay, so it actually, it's not a mistake. Okay, the 16 is actually for the 2020 SETC, and the 15 is for 2021 ETC. That series in the reverse order there. Okay, and of course, the primary form to claim SETC is the IRS Form 7202 for just like for in any other IRS forms, there there is a instruction for that form, and in fact each year there's a different form. So there's instruction for 2020 7202. There's also instruction for 2021 7202. So these are the standard IRS guidance on how you qualify and how you claim the SETC. Right. So I do want to make this disclaimer here, okay, and then you can think of this being a warning. So not all self-employed individuals are eligible for SETC, and so even if you are eligible, so as I indicated in the next couple of slides, so there are actually 4 components of this tax credit. Okay, so there are 2 types, and there are 2 tax periods, which I mentioned earlier already. But there are also, basically there are 4 subcomponents. Okay, so even if you are eligible for SETC, you may only be eligible for, let's say, 1 or 2 components, not all 4 components. And so even in the best scenario, you are eligible for all 4 components, and you may not be able to qualify for the maximum amount of SETC. Okay, so that the maximum amount depends on your self-employed income, and also depend on the number of days that you are eligible under each category. So which we'll discuss in a little more detail in a second. All right, so you're strongly advised to check with the trusted tax professionals to help you to qualify and also do the claim of the SETC. In the very beginning, I mentioned that so the SETC is a colloquial term, but IRS really doesn't like that term, so IRS is not using that term. Okay, so if you search for IRS the document or guidance, there's no IRS is not using that abbreviation. Okay, simply because that SETC can be misleading, because that by looking at the terminology, everybody who is self-employed may think they automatically qualify for that self-employed tax credit. Okay, in reality, it's not. Okay, so there are qualification criteria. And so IRS actually did issue on July 15 an official warning. Okay, so then they are warning taxpayers be aware of, beware of the scammers. Okay, so we just tell you, regardless of whether you are not eligible, you just claim it. Okay, so just like ERC, so not all the employers were eligible for ERC. And so then IRS had to deal with that, and then some of the employers has gotten into trouble for mistakenly claiming the ERC that they are not eligible for. And so same is true for SETC. Okay, so if you are not eligible, and you claim it anyway, so you may get yourself into trouble, and then you are adding a lot of burden on IRS work, and creating a unfair situation for other taxpayers. All right. So now, but I want to go into details so that you have a good understanding of how you qualify and what part you qualify, and then of course, and then how you claim it. So let's break down the SETC. Earlier I mentioned already, so there are four components. Okay, where did the 4 components come from? So first of all, there are 2 categories. Okay, so the categories are sick leave and family leave. Okay, and then which I'll explain shortly. Okay, so there are also 2 periods. Okay, so the first period, as I mentioned earlier, that staggers from 2020 through a part of 2021, and the second period is in the second and third quarter of 2021. Okay, so then the two categories, and then can go in either period. So then you have by pairing them together, you will see that you have the four components. Okay, so the sick leave in the first period, and sick leave in the second period, and then you have the family leave in the first period, and the family leave in the second period. Okay, so these are the four components. And then for each component, so there is the number of days, there are a number of a maximum of days that you are allowed to make the claim. Okay, so for sick leave in period 1, the maximum allowed number of days is 10. Okay, so for family leave in period 1, it's 50 days, and then for sick leave in period 2 is 10 days, and family leave in period 2 is 60 days. Okay, and then that's exactly what I mean earlier when I say even if you qualify for some days, you may not qualify for all days, right? So, for example, if you had COVID for 5 days and took off, you rest at home for 5 days, then you may be on 5 days, not 10 days. Okay, and likewise for the family leave, so you could be, say 25 days instead of 50 days, but these are the maximum number of days you can claim. And then if you don't qualify for the maximum number of days, then of course you won't qualify for the maximum SETC amount. Okay, so the maximum SETC amount is $32,220 per self-employed taxpayer. Okay, so for example, if you have a family and husband and wife both both were self-employed in say 2021, and then each one of you qualify for the SETC, so then potentially you can, as a family, you can claim double that amount, maximum. Okay, and of course, that in order to get that maximum, not only the number of days in each category need to be maximized, but also your self-employed income need to be maximized, which is around 140,000. Okay, I don't remember the exact number, but it's about 140,000 in order to reach the 32,220 per self-employed individual maximum. All right, then how do we qualify for the sick leave, SETC? Okay, so you basically have to see if you have any days you are under one of those conditions. Okay, for example, were there a government order, especially in the beginning of the COVID period, there actually were government orders that require everybody to stay home, right? So it requires quarantine or isolation, so related to COVID-19, that's like a general order, okay? And so what that really means is not specific to you, but basically that's to the general public in your area. Or it's or, okay, not and. Okay, so or if you were advised by a healthcare provider to self-quarantine due to concerns related to COVID-19, I'm just imagining that would include the situation where you have some symptoms, so you want to, or you came into close contact with the COVID-19 at the time, and you want to make sure you are not having the COVID-19. You want to make sure that before you go back to work, so that you don't infect others. Okay, so then if you go to clinic, then the chances were the healthcare clinic would just tell you, okay, just stay home. If you have a more severe symptom, you come back and contact, otherwise you should stay home for either 7 days or 10 days, and depending on which doctor or clinic that's what's telling you. All right, and so if you're experiencing COVID symptoms, COVID-like symptoms, you're not sure if you have COVID-19 and you call the doctors, and then let's say they cannot see you right away, you're waiting, so you're not supposed to go back to work before you have a definitive answer or definite confirmation that you don't have COVID, okay? And of course, if you do have, then you have to stay home for even longer, okay? So, but anyway, so if you are in any one of those situations, so then you would qualify for the sick leave, and also depending on the number of days you were under those conditions, so then you put in the number of days. So if you were 10, you had, let's say 12 days, or let's say 2 weeks, but the maximum you can put down for sick leave in period 1 is 10 days. So if you have more than 10, you just put 10. If you're less than 10, say 5 days, everything went fine, and then you just put down 5 days. All right, and also, let's say if you were not sick, so you had the strong antibody in your body, and so you did not get sick, but someone in your family got sick, and you were taking care of the family member. And so if you're taking days off from your self-employed work and taking care of a family member, then you could also claim the sick leave, SETC, but it will be at a lesser amount. Okay, so so with the details, I'll talk about it in in a later slide. And also, when I say an individual, that could of course be a child. Okay, but there's a different category for the child, which we'll talk about. That's the so-called family leave. Okay, so if you're just taking care of another individual who had those COVID leave, who qualifies for the COVID sick leave, so then you can claim a sick leave, under the sick leave category. Okay, so even though it's not yourself. Okay, and but whether yourself is claiming a sick leave, or you're claiming sick leave based on providing care for another individual who has those sick leave, who qualifies for sick leave, you have maximum number of 10 days in that period. Okay, for the two types of days combined, whether your own days or the days you were caring for someone else. Okay, so the total number of days for the two things combined is 10 days. Okay, so these are not the two separate categories I'm talking about. Okay, these are all sick leave. I'm just talking about one type or one category in one period. Okay, so now let's move on to talk about the family leave qualification in period 1. Okay, so the family leave is called family leave, but in this particular context, it's actually it's a child leave. So basically, if you are unable to do your self-employed work because you need to take care of your child, okay, and a son or daughter, under the age of 18 in general, okay, or unless that child is incapacitated. Okay? So then in that case, you can go older, but otherwise it has to be under 18 years old in 2021. And so then 2020 or 2021, depending on which period, which dates you're talking about in period 1. Anyway, so this, as I mentioned, this really should be a child leave credit. Okay, so if you are taking days off from your self-employed work and in order to take care of your child, because your child's school or daycare place was closed due to for reasons related to COVID, or you could not find a child care provider again due to COVID reasons. So then you can count those number of days that you were off from work for this purpose as the family leave days. Okay, so in period 1, you can count up to 50 days. Okay, so the maximum number of days for child leave, okay, for family leave, really, which again really is a child leave, is 50 days in period 1. Okay, so remember earlier I mentioned the pairing, so there are 4 components. So these are 2 components. They both are in period 1. Okay, so the sick leave in period 1 and family leave in period 1. Okay, so then we have the sick leave in period 2 and child leave or family leave in period 2 as well. And in period two, those credits were enacted by a different law. Okay, so just like for many other COVID programs, such as even PPP2, or even the IDL2 in the second round, and as well as the ERC. So the ARP, American Rescue Plan Act, expanded the period and expanded coverage, and also expanded the qualification criteria. Expanded in the sense that it actually made it easier to qualify. Okay, so the same is true about the SETC in period two. So you can still qualify under any one of the first three criteria, and that was for period one. But you also added several more, okay, such as if you're taking time off to get COVID immunization, which didn't exist in 2020. Okay, so the immunization only started in 2021. So now in period two, so that's a period in 2021. So this new law for that expanded the SETC actually allows the immunization days off to be eligible to be, you can count those days as sick leave days. Okay, again, just like for the sick leave in period one, and either yourself is qualified for those sick leave, or you are caring for someone who qualified for the sick leave, so then you can count both type of things as your sick leave days. Okay, so up to a total of 10 days. Okay, so and again, the second part here, okay, if you're taking care of someone, the second part of the sick leave, actually will be calculated at a lower rate. So if you have a choice, let's say you were sick for more than 10 days or more, and then say your spouse was sick for more than 10 days or more, and then you want to put down your own sick leave days over, that should be your first choice, okay? And then simply because when I show you the formula, you will see that you actually will get a little higher credit with your own sick leave than you taking sick leave caring for someone else. All right, and so the last component of the four is the family leave in period two. So again, that really is a child leave. Okay, so you qualify for this family leave in period two if there are days in period two and you were taking days off from your self-employed work in order to care for a child under 18. Okay, and then the child's school, because the child's school or place of care was closed for COVID reasons, or the child care provider was unavailable for COVID-related reasons. So the maximum number of days you claim in this category is 60 days. So that's the four components with the qualification criteria. So now, how do we calculate? Okay, so the SETC. Now let's say you determine in the first period you qualify for some family leave credits and also qualify for sick leave. So how do you do the calculation? All right. So the first thing you do is calculate your average daily wage. And so if you are self-employed, typically you just self-report your income for the whole year, right? So you're not like when you're employed by someone else, you're paid by the hour at hourly wage, or paid by the month as a monthly salary or something like that, okay? But for self-employed, typically you report your self-employed income on an annual basis. At the year end, you report, let's say, this is how much you made for the year. So from that annual wage, a self-employed wage, and you divide by 260 days, because if you 52 weeks in a year, and then 5 work days in a week, and so you have 260 work days. Okay, so you divide by your annual self-employed income by 260 days. That gives you an average daily wage. Okay, so once you have average daily wage, then let's see how many days you missed due to your own COVID sickness, then simply just multiply by the number of days. Okay, so I remember the number of days for your own sick leave is capped at 10 for each period, and their maximum number of 20 sick leave days. So 20 times the average daily wage, and that will give you your COVID sick leave credit amount. Okay, and so that's basically how you do the calculation. So basically your average daily wage times the number of sick leave days, that give you the sick leave credit. I should mention that the average daily wage for this SETC calculation purposes is capped at 511. Okay, so for example, if you earn $200,000 self-employed wage in 2021, so your average daily wage would be higher than 511. Okay, but in that case, the average daily wage will be capped at 511. Okay, and also earlier I mentioned, so roughly say 140,000 was the cutoff. So if you do the 511 multiplied by 260 days, that will probably give you whatever number it is. So that will be the cutoff wage. Okay. All right. But this is lower of your actual daily wage, average daily wage, and the 511. Okay. So if you didn't have much self-employed income, you have low self-employed income, then you're going to have that average daily income. So then your credit would be less than someone else who had a higher self-employed income in a year, even if the two of you had the same number of sick leave days. Okay, so that's for your own COVID sick leave days. So what happens if you were taking days off to take care of someone else who had COVID sickness, so you are taking care of a child whose school was closed? Okay, so in both of those situations, but because that's not yourself, okay, so you are taking days off to care for someone else, so the law basically reduces the wage you use in your credit calculations. Okay, so it'll be 67% of your daily wage multiplied by the number of days. And also in this category, it's capped at the $200 and not the 511. Okay, so for the child leave or family leave credit, so you are using a lower wage, but you do have more days. Okay, because in the first period it's up to 50 days, in the second period it's up to 60 days, so you have 111 days, right? So what is the maximum? Okay, so assuming your self-employed income is very high and your average daily wage exceed 511, so then for your own sick leave days, it's going to be 511 times 10 days in the first period. And then of course, when you calculate the child leave, and so it's going to be 67% of 511, but still that's more than 200. So that's capped at 200 when you calculate the child leave or family leave credit. So let's say capped at 200 times 50 days, and then that's those two first line. That's for the first period, the sick leave and child leave, and then second line is for the second period. Again, you have 511 times 10 days and 200 times 60 days, because the child leave days, the maximum number of child leave days in the second period is 60. Instead of 50. Right, so you multiply them out and add them together, that's 32 times 220. So that's the absolute maximum SETC amount you can get. But again, by looking at this formula, you'll see that your actual income will play a role in determining how much you will actually be eligible, assuming you're eligible, okay? And then the number of days you qualify under each subcategory also matters. Okay, so for example, instead of 10 days, you have 5 days, then it's going to be less than the maximum there. Even your average daily wages higher than 511. Okay. All right. Let me just go back here. So then I earlier mentioned that you calculate your day and your average daily wage by your annual self-employed income by the number of work days, which is 260. Okay. And so where do you find your self-employed income on your tax return? We know some people are using their Schedule C, and the last line that's called either tentative profit or net profit. That actually is related to your self-employment income, but that's not the accurate self-employed income because Schedule C net income generally is considered in IRS is considered to include employer portions of employment taxes. Okay, so if you're self-employed, you're both employer and employee. So then you are responsible for the employee portion of self-employed tax, and then you are also responsible for the employer portion of the self-employed tax. So that's a payroll tax. Okay, we're talking about the Social Security, Medicare tax there in this context. So and then your Schedule C net income actually, you have to remove the employer portion of self-employment tax. So the wage you use is actually going to be lower than your Schedule C net profit. And then the place where you find the self-employed, your precise gross self-employed income is actually Schedule SE. That's part of your 1040 tax return, personal tax return. Okay, so your tax preparer might not have given you a copy, but in the tax software, in the tax preparer's system, they should have this Schedule SE. So if you didn't have this one for yourself, all you need to do is contact your tax preparer and ask a tax preparer to print out that self-employed tax. There's a Schedule SE. So in line 6 of that Schedule SE, so that is your self-employed income for the year. Okay, in this case, 2021. Okay, in this particular example. All right, so far we talked about how you qualify and how you calculate. So now how do you actually claim? Because I obviously in the end you had to use some IRS forms, to do the claim. So there are 3 forms that are involved. And the first form is Form 7202. That is a form that helps you to determine whether you qualify and how many days you qualify in each of the 4 4 components. Okay, let's call that components. So the category I was using that for the 2 types of credit, then sick leave credit and child leave credit. And so they but then each category of credit needs to have the 2 periods. Okay, so there are a total of 4 components. So anyway, so in the Form 7202 that will allow you to figure out the SETC in each component of the SETC. And once you complete the 7202 and then figure out the SETC, the component of the SETC, and then you can put them onto the Schedule 3. So on Schedule 3, you had to put the 2 different periods together. Okay, so your sick leave and the family leave in period 1 into 1 line on Schedule 3, and the sick leave and family leave SETC in the second period in a different line. Okay, and then there's also a total that you need to put onto Schedule 3. And Schedule 3, Form 7202 is specifically for SETC, but Schedule 3 is for tax credits, okay, including SETC. Okay, so you may already have a Schedule 3 on your original tax return. Okay, so if you didn't, so then you need to complete a brand new Schedule 3. And if you had a Schedule 3 that came with your original tax return, then you need to update that Schedule 3 because the other items on Schedule 3 you still need to keep them. So you just add the SETC components onto that Schedule 3. Okay, so once you have Schedule 3, that will allow you to go to the 1040X to make the amendment of your 1040 tax return. All right, and so then you should use the forms for the year, depending on the dates of your sick leave and the family leave dates. Okay, so if for period 1 and period 2, if all of the dates were in 2021, of course, all you need to just use 2021. But if, period 2, of course, obviously that's on 2021 only, but if in period 1, if you had both 2020 and 2021 days, okay, let's say your 10 days or 50 days split into 2 years, then in that case, you may have to use both years form. Mind you, though, which I'll mention maybe in the next slide or so, so for 2020, you might have missed the claim deadline. All right, so now let's talk about the claim. Now you know what form to use to file the claim, and now let's talk about the claim deadline, okay? So generally speaking, for credit or refund, okay, which is the case for the SETC claim, okay, so you're claiming a credit. So you must file Form 1040X, you must amend within 3 years after the date you filed your original return. Okay, so you can ignore the second part, okay? So for example, if you filed your tax return on April 15 of 2022 for your 2021 return, you have until April 15 of 2025 to file this claim. So you still have some time, okay? But for 2020 tax return, if you filed your 2020 tax return on April 15 of 2021, and actually IRS made a general extension, okay, so automatic extension, not the one that you request. So IRS made a general for everybody to extend the deadline to May 17th in 2021, for the 2020 tax return, okay? So it was May 17th. So let's say you filed your tax return on May 17th of 2021 for your 2020 tax return. So if you want to claim some SETC for year 2020, you have already passed the 3 years, okay? Because that 3 year from May 17 of 2021 is May 17 of 2024, which was a few months ago, okay? So if you're trying to claim your 2020 SETC, you can only do so if your 2020 personal tax return, you filed an extension, and you actually submitted your 2020 tax return on or after September 15 of 2021. Okay, so there are probably a very small number of people that would be in that category. Okay, but I should also mention that because period, what you really care about is the 2 period, okay? The period 1 and period 2. And period 2 is entirely in 2021. So you don't miss period 2, okay, yet. So period 1 staggers into both years, okay? There's there are some dates, basically second, third, and fourth quarter of 2020. There's also first quarter of 21. So in period 1, there is a quarter. There is a date period that's in 2021. So if you qualify for sick leave or child leave in first quarter of 2021, you can still claim it. Okay, so because you're claiming that on your 2021 tax return, not on your 2020 tax return. Okay, so that's the the good news. So if you're worried about your, you already missed your 2020, you really don't miss the credit if you actually also qualify for the sick leave and the family leave in the first quarter of 2021. All right, so this is just basically repeating, or making a little more clarification about the filing deadline. Okay, so to claim the period 2, which is this period, SETC, the deadline is April 15 of 2025, okay, which is yet to come in 6 or 7 months. Okay, could even be later if you actually, when you are filing your 2021 tax return in 2022, you made an extension for the 6 months extension, you actually filed it later, so then you may even have more time than till April 15, 25 to file it. Okay, for period 1, remember, period 1, if there's a portion of it in 2020, so you look at the date periods. Okay, so if your sick leave and family leave dates were in year 2020, so there's a good chance you have missed the filing for that already. But if you do qualify for sick leave or family leave in the first quarter 2021, you can still claim the same amount. Okay, really it's this period that matters. So you really don't miss any credit just because you missed the 2020 SETC. Okay, so provided you qualify for sick leave and family leave in the first quarter of 2021. Okay, so though you can still claim on your by amending your 2021 tax return. All right, so the actual just show you some pictures of what it looked like on the 1040X. So when you do the amendment, so it's this line that where you're going to enter the amount that you're claiming. This is the total amount from both periods. Okay, for both categories and both periods. So the grand total you enter into here, because this is the one that you're changing. And if in this line you claimed some other credit, for example, 8812, that's for child tax credit. So if you claim that on your original tax return, you still keep it here. Okay, so the first column is what you had originally, and then this is the change because the only change you're making is the SETC. So then you add the two together, that will be the new amount, and then you make some new adjustment, new calculation, and you'll see that this amount should be the amount that's coming back to you as a tax refund. Okay, and also I should mention that one thing this is different from the ERC claim is that this you are already claiming on the income tax return. So unlike the ERC, so ERC is claimed on payroll tax return, and then once you get the ERC, so then you are required to amend your income tax return. So that's a two-step thing. You first use amend the payroll tax return to claim the ERC, and then you amend the income tax returns. In fact, when you amend, you may have to amend both the company income tax return and personal tax return. Okay, but for SETC, the claim is on the income tax return. Okay, by amending your personal income tax return 1040. Okay, you're directly amending the income tax return to claim the credit. So there's no other amendment to do. You just do the so then you use this form to claim the SETC, claim the credit, and also at the same time you already got your income tax amended. Okay, so and then whatever that amount, that's going to be the amount that's coming back to you, and you don't have to pay a portion of that SETC back to the government as like taxes on that. Okay, so you just get that credit as a fully refunded, and then in fact, and you're going to even get some interest because this were credits that you were eligible for year 2021, and you're still claiming within the time allowed. So in other words, IRS has been holding on to this credit since 2022, because that's the time you file your original 2021 tax return. Okay, so now a couple of years already passed, so you actually are entitled to some interest on top of the credit. So, but of course, you don't know when IRS will be processing you. You don't know. Won't have a way to calculate how much interest you'll be getting. But I would say probably, like say 10%, somewhere in that neighborhood would be a good estimate. Okay, a few pointers I want to mention. For the Schedule C net income, I mentioned it earlier already, actually. So the self-employed income, the gross self-employed income, is actually a little bit less than the Schedule C net income, because part of that Schedule C net income is employer's payroll tax. So you have to take that part out. So to get an SE income. So same is true. If you were filing 1065 and you got a K1 with some number on box 14A, so that which is the K1. Not all K1 are equal. Okay, so that's even for 1065 K1. Okay, so for 1065 K1s, some have a number in box 14A, some don't. Those who actually has a number on box 14A, you also are eligible for this SETC. Okay, so the SETC is not just for Schedule C filers. It can be for some of the 1065 owners. Okay, for 1065 owners, you need to check your K1 to see if you had some number in box 14A. If you did, so then you qualify for the then if you had a number in box 14A when you file your personal tax return using that K1, that will bring up the Schedule SE. So then you will have self-employed income. So then you can claim this SETC. Okay. So that's one thing. Also, when you do the calculation, which I showed you earlier, and that you cash, so basically from your annual SE income divided by 260 days to calculate your average daily income, and you can actually use the higher of the year you're making the claim and the prior year's self-employed income. Okay, so for practical purposes, now everybody is probably, if you're going to claim this, you'll be claiming on your 2021 tax return. And so then you can actually compare your 2021 self-employed income and your 2020 self-employed income to see whichever is higher, and you can use the higher of the two to do the calculation for your SETC. All right, and a few other pitfalls, and so just like any other COVID grant or COVID credit, the federal government does not allow double dipping. Okay, for example, you cannot count the same day twice. Okay, so for example, if on a particular day you were sick, and your child's school was also closed because there's a COVID breakout in the school, so the school was closed. Which happened to be the same day that you were also sick. So now for that day, you can only count it once, whether is it going to be your sick leave or it's going to be the child leave day, and you cannot count that same day twice. But of course, you were sick for 10 days, but then your child's school were closed for another different date period for 50 days or for however many days. So then, of course, you can count those days as long as there's no overlap. Okay, any overlapping days between the two categories, between family leave and the child leave, or between sick leave and child leave, you can only count once if it's for all those overlapping days. Okay, and also remember period one. From 2020 all the way to March 31st of 2021, that's all one period. Okay, so all of that is period one. Say if you claim 10 days on your 2020 tax return already, and then you did caught COVID again in first quarter of 2021, and you cannot claim another 10 days, okay, because that first quarter 21 it belongs to the same period one as those 3 quarters in 2020. Okay, so if you claim in 2020, you cannot claim that in first quarter of 2021 because that's all one period. But of course, if you were sick again in second, third quarter of 2021, so and then that's a second period. Okay, so period one and period two are independent. So if you qualify for both periods, you can claim that credit in both periods. And also should also mention another situation where the double dipping might happen. Let's say if you are self-employed, but you also were employee of some other employer. Okay, and then the Family First Coronavirus Act, Coronavirus Response Act, that actually, it's a general law that, there are a lot of COVID credits discussed in that, authorized in that law, including the sick leave and family leave that the employer can take. Okay, I'm talking about those bigger employers, not just self-employed, your own employer. I'm talking about the employer that you are an employee of. And so those employers, they could claim if you took any sick leave or family leave because for COVID reasons. So the employer could also get a credit, okay? Because the employer is paying you that wage, and then the employer get a credit from the government, they just pay you. So the employer could have taken that credit. So, but it's for the same individual, okay? For the same individual, for the same sick leave days or family leave days, right? So, you cannot double dip in that situation, okay? So if you are in that situation, you want to make sure that the employer did not claim that credit and so on, counting you as the COVID sick leave or COVID family leave. Okay, and so I think this should be my last slide. So just show you quickly. So on the Schedule C, I was telling you, so this is not the SE income, okay? SE is on Schedule C. You see this number, that's the net profit. Okay, so that's actually not the your income yet. Okay, you do need to go to Schedule SE. Okay, so likewise, 1065K1. If you have a number in box 14A, so but these two numbers do tell you do have self-employed income. Okay, just those are not the exact number yet. So they do tell you either the box 14A of K1. Or this Schedule C line 31. If you have a positive number there, you had self-employed income. But for the precise self-employed income, in order for you to do the calculation, you have to go to Schedule SE. All right, so that finishes my talk today. So I just want to quickly mention that. Our firm has a standard, has a sizable, I should say, CPA firm with 5 offices. We do serve a lot of people, and then we cover a wide range of services from tax filing to accounting, and also financial statement audit, running payroll, and other general business consultations. So if you have any other questions, you're welcome to contact one of our partners to schedule an appointment for further consultation, further information. Okay, so that you can find us on our website, communitycpa.com. And if you are not yet our YouTube channel follower, please follow us on our YouTube channel so you can subscribe to our YouTube channel. And also, once again, you can go to our website at communitycpa.com to find our webinar announcements, and then at the YouTube channel you can find our past YouTube webinars. Okay, so including this one, this will be on there pretty soon as well. And if you have any other questions, feel free to send us an email at our general firm email, Catherine@communitycpa.com. Or call us at 515-288-3188, 6 days a week, from 8:30 to 5:30 p.m. Monday through Saturday. That's Central Time. Right. Thank you for your listening and watching. See you next time.